Hi guys, how are you? My name is One Titanium. Welcome back to MMT, Evidence-Based Economics and Investing. So let's talk about our little economy that we created from scratch, and I'll just recap it really quickly in the beginning. We started with a blank piece of paper. You are the, you know, whatever, the king, the ruler, whatever. You create a government, and then you create a bank for the government. And as we all know, the Fed is independent within government and not of government, so it's not private. Forget about that crap. And it also, the government creates money out of thin air, and then that money is spent into circulation. People work for it, and then once the labor is complete, a portion of it is taxed, and the residual amount goes into savings. Okay. Then we added in banking, and banks are agents of the government, and what they do is create money out of thin air as well. So they pump in what is called horizontal money because there's an interest rate associated with it. Some of it gets taxed, and the residual amount ends up in savings. Now, remember that interest payments are interest income to somebody, and in this case, it's the banks, and then the banks collect that interest money, and they also store that money in the savings. All right, fair enough. So now we're going to talk about bonds. Okay, so you have all these bonds just sitting there idle, doing absolutely nothing, and the government says, "Hey, why don't we tap into some of that money?" And what we'll do is we'll take that money, we'll recycle it back into circulation, and we'll offer an interest rate which we will pay. Okay. So what happens is when interest is paid on that money, it bypasses the functional economy. Okay, that money goes into savings. Now, some of that money, a portion of that money, does make it back into circulation, but the vast majority doesn't. Okay, so when you have deficits, and 1/3 of those deficits are going to the non-functional part of the private sector, the savings, then all it does is blow up asset prices. Okay, um, and there is they do borrow a portion of it, um, usually a larger amount than they issue to savers. Okay, and we'll see that in a second here. All right, so this is the checking account of the U.S. government. And when you see here, it redeemed $8.4 trillion in bonds that it rolled over to 8.8 trillion, 8.9 trillion. So the difference is about 450 plus billion dollars. Okay. It also paid interest to the tune of where is it? No, that's not correct. 239 billion to savers. All right, and it collected 2.8 trillion in tax revenues, and then you had some other small amounts and some income from other sources. So let's take a look at it now. How it all fits together. All right. So the government borrowed about 450 billion. Okay, from savers to spend back into circulation. In return, it paid 239 billion to savers. Okay, that money went in here. So you can see that we borrowed more than we paid into savings. Now, we also collected about 2.8 trillion in taxes, which that also gets spent back into the economy. All right, and then that ends up in savings. All of it together ends up in savings. Plus, we deficit spend about, if my mouse would work right, I could probably, there we go, 650 billion money created out of thin air, quote unquote. Okay, and then that made its way into circulation. And we also, of course, have private banking, and that money made it into circulation, and then it ends up in savings. Okay, and of course a portion of it gets taxed back. All right, and that's the way it works. So what ends up happening is that the savings bubble gets bigger and bigger and bigger and bigger over time. So in an MMT economy, there would be no bonds and there wouldn't be no interest rates. Okay, All it would be is about, let's say, roughly a 2%, a 2% deficit, continuous deficit, plus or minus whatever the economy requires at the time, um, to to keep the growth going. Um, but that's what a true MMT economy would look like. Just spending to whatever the economy requires in the parts of the economy that do require it. Okay? And then that would just make it through circulation, ends up in savings. There would be no feedback loop or nothing like that. No interest payments to savers, no nothing. It would just be 2% or whatever. Okay? That's it. That's a true MMT world. But we're not there yet. Okay? Now the problem that I have with that is if you have, let's say, 20 trillion in savings, right, and 20 trillion of so-called debt, what's going to happen? That 20 trillion, okay, that is, let's say, in bonds, is going to have to be liquidated, and then that money will have to make it into other asset classes, commodities, stocks, whatever. Okay, and some of it, of course, will be spent back into circulation. But nonetheless, it would blow up all the other asset classes, which is essentially what we did with QE, right? What happened? We took four point whatever trillion, and we said, look, we'll take that money onto the balance sheet, those bonds onto the balance sheet of the Fed. In exchange, we'll give you some cash for it, okay? And then you go out and you spend that cash however you see fit, And some of it went back into bonds, right, which lower interest rates, and some of it went to stocks, okay, which stocks started to rise. And then, before you know it, you have price stability. You're not getting inflation because that money is not necessarily being pumped back into circulation, where it's starting to create inflation, where we reach maximum employment and maximum productive output, and then there's more money being pumped in, chasing the same amount of goods, which creates inflation. Okay. So, if QE continued all the way to 20 trillion, then guess what? All the money would be in other asset classes. The Fed would be holding its own debt essentially, and we are now in an MMT world. Okay, that's how that would go. So it's important to understand MMT correctly. We are not there yet. We don't live in that world where we don't have bonds and interest rates and so on. Okay, where the government just spends a nominal amount every year or whatever. We're not there yet. Okay, we are somewhere in the in-betweeny kind of stage. So that's it for now. We'll talk more about it as more videos come out, and we'll start playing with this a little bit and try to understand um, how the economy is structured today and how it's going to look going forward, um, and what does that mean for our investments, right? How are we going to trade? How are we going to make money off of this information? All right, that's it. If you have any questions, as always, come to my messenger. You're a Patreon subscriber. You're entitled to the messenger that we talk about investments and trades and charting and all that good stuff. And just let me know, because I know some of you are not still on it. Um, Hopefully you'll join us and you'll get a lot more out of this service um, over the course of time. That's it, guys. Thanks a lot, and talk to you soon. Bye-bye.